All right, let's talk about the 10-year rule. So the IRS mandates that most IRAs, so pre-tax accounts, whether it was a 401k, 403b, TSP, SEP IRA, solo 401k, once those get rolled over into what we call a rollover IRA or a traditional IRA, that IRA, once that goes to your beneficiaries, that account, has to be empty within 10 years. So there used to be something called the stretch IRA. What was a stretch IRA? That meant if your kids, Yelisey, or my kids received our retirement assets, they could stretch out that IRA over their lifetime, which I believe was somewhere right around 27 years. So what was nice about that is our beneficiaries had, basically by the time we passed, the rest of their life to take money out as they needed, and they didn't have to pay taxes until they needed it. One of the things the government noticed is that they were having to delay taking any of this money. And if you think about it from their standpoint, they've allowed you and I and all of our listeners to put money into a 401k, a 403b, a TSP, an IRA, write those dollars off in hopes that once those dollars have accumulated, that they can now have a piece of the action. Well, what ended up happening is these people would pass their accounts down to their kids, and now these IRAs are 30, 40, 50, 60, 70 years old, and the government hasn't been paid yet. So what they did is instead of doing the stretch IRA, they eliminated it, and they put a time clock of only 10 years on that. And what that means is that now you're required to take money out of that account, and it has to be emptied within 10 years. What are some of the tax implications to the beneficiary?
So the stretch IRA, what actually, as you mentioned, what made it the stretch IRA as well is your children. So let's say you pass it on to your son or your daughter, but your son or daughter doesn't need the money, at least back in the day. Let's say that they were still, maybe they're at the height of their career, they're earning well, and they don't want the IRA. They actually could sign a 9-month waiver, passing it on to their son or daughter, your grandchild, right? And that's what allowed it to be considered a multi-generational IRA or a stretch IRA. So when they eliminated that, one of the biggest things that actually I want to point out is this is on a non-spousal beneficiary, because if you're a spouse, right, if you pass away, chances are you're not going to pass away together at the same time. So the first person to inherit your account is your spouse. And your spouse actually has a couple of options. Your spouse can inherit the account as an inherited IRA. And the reason why they might want to do that is if they haven't attained the age of 59 and a half. On most IRAs, on most pre-tax accounts like an IRA or a 401k, if you take distributions prior to 59 and a half, there's a 10% penalty. The one exception is if it's an inherited IRA. So some spouses may want to have the availability of those funds. They want to be able to take distributions, so they keep it as an inherited IRA. However, if you're over the age of 59, or maybe that's irrelevant for you, you can just move it to your own IRA. There's an automatic spousal IRA rollover. So if your spouse passes away, you can just combine those assets with your IRA as if it has always been your traditional IRA. So apart from that, it's really when the second one of you goes that you have to deal with a 10-year rule. When both of you pass away, eventually your non-spousal beneficiaries are going to inherit that account. And that's where they have to deplete that account within 10 years. And it's true on traditional IRAs. It's true on Roth IRAs. The tax implications are different, but both of those vehicles, they have to be depleted within 10 years. So when this rule first came out, there wasn't a lot of clarity on how that needed to happen. And they've since clarified a lot of those things and have added some more rules to help make it a little bit more complicated for all of us. But one of those rules is, so if the person who owned the IRA, if that person has reached their required beginning date, in other words, that person has already started taking their RMDs, then the non-spousal beneficiary who inherits the account must also, at a minimum, continue taking RMDs. It's based on a different life expectancy table based on that person's date of birth, but that person needs to maintain those RMDs. In other words, the federal government doesn't want to lose out on revenue just because somebody inherited that account. And then within the 10th year, that account needs to be fully depleted on the 10th anniversary of that person's date of death, if you will.
Yeah.
So that's when that account needs to be fully depleted. However, if the person who initially owned the account has not reached the required beginning date, then the person who inherits the account does not need to take RMDs on any schedule. The account still needs to be depleted within 10 years, but they can do it at their own discretion.